Perfect.
There we go.
I love doing it in a small, kind of setting like this. So if you have any questions, just blurt it out. I prefer it that way. It's just kind of open forum. I'm going to share my screen here. Let's see. We'll start with this. All right. This is my webpage, ccmbullock.com. This is where I am funneling the majority of your buyers, both of our buyers, if you will. They're going to come here and they're going to maybe, read up on some information about mortgages, but most of the time they're rolling right down here to apply now, where they're going to get the online application started. So I just like to kind of show, here's a little bit about me if you're curious about my background. This is kind of the landing page where it all starts for a buyer when they're getting the application started. The other site I like to bring up is this one, Mortgage News Daily. The thing I look at most is right here. This is giving a national average from a survey of all the major mortgage companies all across the US. This is useful because you're seeing what most people across the nation are seeing for interest rates given, these kind of catch-all programs. Most people falling into this 30-year fixed here for conventional, 30-year FHA. So you can see we're a little over 5% right now on a national average. Cross country's coming in pretty close to this. I'd say we're at or just above 5% right now. And my hope is, if you look at this chart, this is over the last 8 years here, 10 years, we are at the top. This is the highest we've been in a while. So I anticipate it getting back down to here. If you ever want to have a 20-minute conversation where you hear me ramble about rates, just knock on my door in the office and I can go on and on about the economy. All right, let's hop into the actual presentation here. So fun and funding. It's kind of a general catch-all, new agent training. If you haven't, dug too deep into the financing side of things, this is just going to be a catch-all. The reason I like to do it kind of open forum is if you have any questions along the way, let me know. So we'll start with the common questions that you're going to get from a buyer. So you send me someone's number, I give them a call, I say, Alicia, sent me your info. What questions do you have for me? Most people, well, how do I get started? Send them to my webpage, apply now, get all your information in one place, because that is how, we're going to put the puzzle pieces together and come up with, what are you qualified for? Which loan program is right for me? This is where the credit report comes in. We're going to pull the credit report right up front, assuming they're comfortable with it, of course, and then we are going to get a good idea of, well, you qualify for these couple of programs, or we'll get into some of the miscellaneous, non-conventional, non-FHA stuff. I have a class coming up on some of those here in the next month or so. Keep an eye on the training calendar, but that's basically the next thing. We're going to put together a roadmap of how do we get you qualified? What's the best way to get you into a home? How much can I afford? That's going to be, putting together that debt to income ratio, finding out what the monthly payment is going to work for them. How much money will I need? That kind of comes hand in hand. Once we know, what your purchase price is, what your loan program is, we're going to figure out what the minimum down payment is, what your comfortable down payment is, and what closing costs are, estimated. How much will my credit affect my ability to get a loan? That kind of wraps in with the credit report. I have a lot of conversations about credit, especially with people that are around 580 to 620. Reason being, 580 is the minimum for an FHA loan. We say anything from 580 to 620 is going to be considered borderline. What I mean by that is you're going to need to rely on some other parts of your credit profile to make up for the fact that you have a lower score. We're going to need some extra funds after closing in reserves, basically savings. We will likely need a lower debt to income ratio than you might be able to get with someone that's, say, a 650 score or higher. What is the process? So we'll get into more detail on that throughout this, but once we have everything together, we put together their credit profile, we have a roadmap. We're going to get into pre-qualification. Pre-qualification is, and I'm sure you've heard this before, it's very preliminary. There's generally no documents. It's just verbal. You tell me what your income is, you tell me how much you have in the bank. We pull a credit report, of course. We do have the option to do a soft pull. So some people don't want to have a hard inquiry. They just want to know, well, I want to get an idea of what I can afford. I don't want to go out and buy a house tomorrow. We have this soft pull in our back pocket. I don't like to use it a ton because it only pulls, I think it's 1 or 2 scores. The catch is if we pull that 3rd score with the hard inquiry, there could be a collection or something that's only reporting on that 3rd score. And now all of a sudden, here's something we have to remedy before closing that no one had any idea of. It always makes me a little bit nervous to go with the soft pull. The hard pull just gives us a full idea for 120 days of what we have in front of us.
Hey, Chris,
yes.
I'm still seeing today's mortgage rates. I don't know if you had a separate presentation, but that did not switch the window if you did.
Oh, no.
That happens to me like every day. So I just figured I'd let you know.
Thank you. I've been flying through slides, which is funny. Can you see this?
Yep, now we see it.
Where do I start? Okay. There's no fee to a pre-qualification pre-approval. If your buyers are running into a lender out there in the world that is saying, hey, you owe us, $50 to put this together, I would say run, because, I don't know anybody that's doing that. It should be free. It's an advisory thing, and that's how I like to treat it. We pull a lot of credit reports where people, they have less than desirable credit. There may be just a few items on there that need to be remedied, and with some good advice, they can get to that point. And I'll always do that. I'll tell them why their score looks the way it does, what the next, couple of good steps are to get it up. And, I always give them I have an open line, email me, call me, text me, whatever, if you have any questions along the way. And of course, there's no commitment to lend with a pre-qualification or a pre-approval. They're not forced to go with us. They can absolutely shop around. What do you think I can do based on what you were telling me? This is, like I said here at the beginning, verbal. We can come up with a pretty good plan with this, but really what I'm going to say is, next step, get me your documents so we can upgrade this to a pre-approval. Buyer provides us the documentation to verify their income, their assets. We'll get W-2s, and there's a whole thing about the documents we're going to need down the road or in a future slide here. But once we have that, application is complete. We have the full credit report instead of the soft pull, and all the information is verified. Technically speaking, it's not a fully underwritten pre-approval unless you do a fast track, which is a cross-country specific program. However, with a regular pre-approval that you get from me, it is run through automated underwriting. What that is Fannie Mae, Freddie Mac, they have designed these computer programs that act as underwriters, can look at the full credit profile, look at the application, and come up with, an approved eligible or a refer. What refer means is refer to a human being underwriter, because the computer couldn't make a decision. People are not going to be denied through the automated underwriting system. It will always either be, yep, approved, or nope, send it over to an underwriter. So the fast track pre-approval, the reason it's so special is up front, we're going to go to the human being underwriter. So it's got a little extra weight to it. Someone's looked at it, an underwriter has approved it, and it allows us to basically say, yeah, all things considered, assuming you find a property that fits into your, kind of profile, the way we've set things up, we give this a 99.9% chance to close. Once again, no fee, and keep an eye out. No one should be charging for pre-approval. So whenever we're determining, hi Doris.
Hi.
Whenever we're determining what loan program is good for somebody, what we're looking at is their credit profile, probably what they are ideally putting down. Do they own a home already? And we're going to probably fit them in. I'd say 99% of people are going to fit into one of these programs. Conventional, that's the obvious one, the tried and true, everyone's favorite, conventional. Technically speaking, going to need over a 680, or you're going to need a co-borrower with a good score that's kind of carrying you along the way. I would say really likely anymore, 680 is going to require a maybe 15 or 20% down payment to get approved. Conventional becomes a no-brainer when you're over 700. Anyone over 740, I don't even mention FHA because doesn't even apply. When it comes to credit scores and interest rates, 740 is the best. You could have a 740 score, go to the next person, they have an 800, they're going to get the same interest rates. So sometimes people are like, why aren't I getting a discount for being an 830 score? Well, it cuts off at 740. Everybody 740 and higher is considered to be excellent. Next big one, FHA. These two are going to wrap up the vast majority of the loans you see out in the market. FHA, government-backed loan program. Most first-time home buyers, I would say, are falling into this program, assuming they don't have really good credit, because conventional has their own type of first-time home buyer program called Home Ready, Home Possible. Great program, allows you to put 3% down, take an online class, 2-hour class, get a certificate, reduced interest rate, reduced mortgage insurance. If you want to hear more about that, let me know. I'm happy to talk more about that. But for the rest of the people out there, FHA is probably where they're going to fall. 3.5% down, credit scores as low as 580. And because it's government backed, there's way less risk on the lender. So you're usually going to find the interest rates are lower. Less implied risk, always going to mean lower interest rates, less cost to the buyer. With FHA, kind of a one big catch, and I know I'm going to come back to this when we talk about PMI later, but I want to mention it while it's on my mind. FHA, if you're putting less than 10% down, the mortgage insurance is on there for the life of the loan. If you've got a 30-year term, mortgage insurance is on there for 30 years. That scares people a little bit. What I always say is, you start as a first-time home buyer in FHA. Most first-time home buyers are going to be in a property for 5 to 7 years at the most. We're going to look to get you conventional on the next one. If you fall in love with this house and you think you're going to live there for 30 years, we'll refinance you out of FHA into conventional and eliminate that PMI. So it might be stuck with the loan for the life of the loan, but not as long as you're living there, because we've got some tools in our back pocket to get you out of that PMI. VA, less often used, but only because it is for veterans only. Another government-backed program, no money down, no PMI, super awesome program. If you have veterans out there that are interested in getting a home, this program more than likely is giving them the ability to do so. And there's no minimum on the credit score. So we've seen less than 580 get approved. They have a second calculation called residual income. Basically, they want to make sure that not only can you afford the house and the debts that we see on your credit report, they also want to make sure that you have some residual income for your kids and clothing and other expenses and your monthly bills, such as like, your utilities. So there are some calculations we have to run just to make sure that the numbers do work, but VA, excellent program. Don't do a ton of them, but love them when I do. There are some other programs out there. Those are going to be, USDA is one. We don't see this one a ton. Never going to see it in Cuyahoga County. It's going to have to be in a much more rural area. And you have to meet, I think it's the 70 or 75% of the median income. That is the cap. So the income level, pretty low. You would need the ideal property and the ideal buyer to fall into a USDA loan. We have some other non-conforming is what we call it, non-conventional programs. I will hit those at the end. Any questions?
This is great so far. Thank you.
Like I said, stop me anytime. So how much can I afford?
Excuse me, one question. This new program you're referring to, who's eligible for it?
Which one?
The USDA you were talking about, the one you just.
Oh, USDA. So that's been around for a long time. But it's a government-backed program for buyers that are buying in a rural area. So it's really going to be outside of Cuyahoga County for sure. It's going to need to be in an area where, the buyer can't have more than 70 or 75% of the median income for the area. So most of the time in a rural area, that's probably capping out somewhere around 50, maybe 55,000. We have a map that the government provides. You can just Google search it and find out what the median income is for an area. And it'll basically say, here's what qualifies for USDA. So honestly, I've never done one. I think Sean did one or two all of last year, and he does a ton of loans. So it is a very, very small part of the market.
And do the government have programs for first-time home buyers where they have, do you all do that, the company, where they, grants for first-time home buyers?
Yeah. So there are two major programs we work with across country for down payment assistance. Those still going to fall into either conventional or FHA, but you can also get a grant, or what it ends up being is a second lien on the property. It's basically a second mortgage that is paid off by the government as long as you stay there for 7 years. So I will start at the top. There are two programs, OFA, which is the state one, and then Communities First, which is a third-party nonprofit grant program. There are income limits. There are minimum credit scores. Both of them, I believe, are 650. Assuming you fall into both of those categories, we are going to look to get you qualified for a conventional or FHA loan. Then we are going to look at getting you through the classes to qualify for either of those two specific programs. Communities First is a grant. It's a 3% grant to go towards your down payment. The only trade-off is your closing costs will go up slightly, which can be covered by the seller, assuming they're not already maxing out their seller credit, of course. And your interest rate is going to go up a little bit. With OFA, it is a second mortgage, basically. They're going to provide 2.5% or 5% to go towards your down payment. In exchange, you have a slightly higher interest rate, and then there is a 1% origination fee as a part of your closing costs. Once again, assuming that the seller has not already contributed the max, they could, kick in a seller credit to help cover those closing costs. So in the ideal scenario, you could probably get someone with no money out of pocket in a house with this grant. Now, The catch with the OFA one is there's some kind of extras there. Because it's a second lien, it's going to hang with the property. After 7 years, they will forgive it, basically paying it off and removing the lien. If you are to move before then and you don't meet any of the, exigent circumstances that are listed in their guidelines, you would be required to pay some or all of it back. So kind of a lot of catches with OFA there. We do some communities first, a little bit of OFA. As competitive as the market has been for the last couple of years, haven't done a ton of these. With the rising interest rates, the rates on these are now looking pretty high by comparison, because, to get this grant or this second mortgage through OFA, you do have to take a higher interest rate, and that's a bit of a trade-off. You're definitely going to be paying more per month in exchange for less upfront outcome. But great programs. When people fall into the requirements, I love to have this conversation with them, send them to those websites, let them read for themselves, and if they feel like they're interested in moving forward, let's do it. We're happy to do it. Any questions about that? Alicia?
I didn't have a question, but we were talking about USDA. I just wanted to let you know, Doris, that I'm working with a USDA buyer right now. So it's not super rare. All of Ashtabula County is actually USDA,
Oh, nice.
supposedly. So if you have any buyers out there, and probably part of Geauga would be too, they're required to accept USDA, I believe. And then I lived in California, in a rural area in California, and right outside town, it was USDA everywhere, which I believe is no down payment. Am I correct?
That's correct. Yep.
Yeah.
It's a lot like VA, no money down. I think that there is PMI, but it's not too crazy. I would have to look at the specifics, but that's awesome. Yeah, it's definitely, most of our loans are in Cuyahoga County, but yeah, I imagine you slip outside of Cuyahoga County and you're probably going to be able to qualify for a USDA loan for sure. Cool. So how much can I afford?
Thank you.
PITI. That's principal, interest, taxes, and insurance. So private mortgage insurance and homeowners insurance. We are going to qualify someone on their monthly payment. So basically how we come up with qualifications. A lot of buyers, especially if this is their first time buying, maybe their first time even working with a banker, they think that, we make an opinion. I just, decide how much we're going to lend them. The reality is we're just doing a calculation that's predetermined and running it through an automated system. So the way that we come up with that, we're going to take this bottom line calculation, their PITI on their new prospective property. We're going to add that together with their monthly debts. So your car payment, your credit cards, if you got some student loans, we're going to add all those up. We're going to take 50% of their gross income. So pre-tax income, 50% of that, most of the time is going to be the max. FHA, you can sneak a little higher than that, but most of the time that's going to be the max. And we need that. We need this calculation and that calculation to be equal, or we're going to have to reduce something to make it work. We're going to need to, I want to jump ahead here. We're going to need to do something to increase their purchasing power. How do we do that? A couple of ways. Pay off credit cards. That's one way. One of the first things I look at, if someone's just barely missing it, some cards, you could have a $500 balance and a minimum payment. Oh, sorry. Give me 1 second. My phone's ringing. You could have a minimum payment of $100. Well, take $500 out of pocket, pay this off at closing, and we just opened up $100 a month in available payment for you. That might get us right below that debt to income ratio we need to get approved. We could pay off or pay down installment loans. So little trick with installment loans, most of the time, that's going to be a car payment. But if you have 10 payments left, so say your monthly payment's $250, 10 payments, so $2,500, that's all you have left, we ignore it. We can just ignore that payment altogether. So let's say you had $3,000 left. Well, if you took $500 out of pocket, paid that on your car, got it down to $2,500 balance, now I get to ignore it again too. So sometimes to ignore some of these installment loans, especially if it's a really, large car payment, we might just put a sizable payment on the car, pay it down to where there's only 10 payments left, and then just mark it as exclude from their monthly debts. And that could open up a pretty sizable, available qualification there. Consolidate student loans. We don't run into this too much as of late because student loans are in forbearance and everyone just wants to ignore them. Student loans, the way that they work for the lending side is we can't use the 0 monthly payment that shows up on most people's credit reports right now, because someday they anticipate those student loan payments are going to kick back in. So we have to use a calculation. It depends on if you're going conventional or if you're going FHA. We use either 1% of the outstanding balance as a placeholder payment or a half of 1%. And FHA uses the half of 1%. One kind of tool or way around that is if someone is to consolidate their student loans, it would normally kick back in out of forbearance and you would be, expected to make your monthly payment. But let's say you are set up in a, like as a teacher, and you are planning on working so that your loans are forgiven. If you can get a letter that says that you qualify for income driven with a 0 monthly payment, we can use that 0. So that's a lot of steps for sure. We need some documentation to make that work, but I have done that. I've even done that with a dental student who is qualified for a doctor loan. She had just gotten out of, grad school and medical school and dental school, I guess. And she's going to go work her first job here. It's income driven and her student loans were, $200,000. Her monthly payment was much less. It wasn't 0, but it was some. We could use that because she was income driven and her first job wasn't paying her a ton, got her qualified for, a pretty nice starter home for sure. So some of the tools out there. We can always make a larger down payment, which can be a pill to swallow. We can look at adjustable rate mortgages. You're going to hear that more and more as interest rates rise. Adjustable rate mortgages tend to be lower than fixed rates whenever the market is volatile. Reason being, they generally are going to be fixed for a period of time up front. That's going to be 3, 5, 7, 10 years. They can even extend as far as 15 years, although at that point, you might as well look at a 15-year fixed rate. They will adjust every 6 months. So with an adjustable rate mortgage, probably looking at fixing it for an upfront period of time for a lower interest rate that you feel comfortable, being at the home. Much like FHA, I would say, all right, so we've locked it in for 7 years, and then, years 8 through 30 are going to be adjustable. How long do you think you're going to be in the house? We're only living there for 5 to 7 years. Cool. Then this loan is never going to adjust anyway because you're going to sell it before we get to that point. What happens? I fell in love with the house. We, put it in the back porch of our dreams, and now we want to stay forever. Let's refinance it out into a fixed rate. And, we can do 15 or 30 years, and there you go. Now you can live there forever and not have to worry about the rate adjusting on you. So like I said, tools out there. Adjustable rate mortgages are super, effective upfront to just get you in a home. We could always buy multifamily. I've done a few loans like this. It's hard in this market because it is so competitive, but with FHA, we can use anticipated rent to offset your monthly mortgage payment. We use 75% of that anticipated rent when you're purchasing a multifamily that you are also going to reside in. So I did one last year. She by herself was looking at maybe a $90,000 purchase price. Well, she didn't have $90,000 in mind. She wanted to go higher. Well, let's look at duplexes. Would you ever consider maybe living in a duplex and renting out the other side? Sure. Okay. Well, that offsets 75% of half of the cost of the other side. And there you go. Now she's approved for 140, 150. Super useful if the buyer's open to it, if they are willing to consider it. I'm going to jump back because I know I skipped a slide here. PMI. I should say Sean has a whole class and I have adopted it. It's definitely on the training calendar. It gets pretty in depth, how we calculate PMI, what exactly PMI is, the history of PMI, why it's useful. Sean's name for it is having a PMA about PMI, having a positive mental attitude about private mortgage insurance. So just kind of a quick rundown on private mortgage insurance. It's a third party that's basically coming in to insure the bank in the event of a default because the buyers are putting less than 20% down. I know that's a lot, but basically, whenever a lender is determining whether or not they will provide financing, they will look at implied risk. When someone is putting less than 20% down, the implied risk goes up significantly. So instead of having a line in the sand where you either go FHA or you have 20% down and you go conventional, people with good credit can go conventional, put less than 20% down, and use this PMI as a tool to offset the bank's risk that they otherwise would just say, no, I'm not going to be doing this loan. I'll get more into the specifics of that at that class. If you're interested, please check it out. But, one cool thing about PMI, I'll just throw this out there. It's also a tool to cover appraisal gaps. If you have a buyer that is putting 20% down and we have an appraisal gap, let's say $10,000, they don't want to bring any more money out of pocket, we can use PMI. Assuming they have pretty good credit, the PMI, monthly PMI is not that much anymore. It might be 30, 40 bucks. So what we'll do is say, okay, you're going to bring the same amount out of pocket, but instead of putting 20% down, we're going to put, I don't know, say 18% down. We're going to use that $10,000 to cover your appraisal gap, and now you have mortgage insurance. So if they're okay with 30 bucks a month, there you go. That we just solved a problem. Or we can pay off the mortgage insurance up front with a one-time fee at closing. Given good credit, it's probably not too expensive. It does depend on their loan amount. So, if someone's looking at a $500,000 loan, that might be a pretty good chunk of change out of pocket up front, but we'll cross that bridge when we get there usually. Any questions? Cool. How much do I need? Down payment, closing costs, prepaid items, reserves. So some of these are obvious. Down payment, that is going to be required. 3% down for first-time homebuyers conventional, 5% down for anyone else conventional, 3.5% down for FHA, no money for VA, no money for USDA, and then any kind of other non-conforming programs, we have to refer back to their specific guidelines. Closing costs, usually it's just title fees, different for every title company. Prepaid items, to be prepaid interest, first year of insurance up front, And then the reserve, or I'm sorry, the escrow. So a couple of months of taxes in the escrow account, couple of months of insurance in the escrow account. And that's just to get it started so that when those bills come up in the future, you have the money there to pay them. Reserves are any extra money we'll need to see in your bank account. You're not going to send it to the title company. You're not spending that money. It's just, we need to see that you've got some savings. If you lose your job, you've got a little money left over that you could make your mortgage payment. Those usually come in to help save a deal. If the, debt to income's really high, the credit score is a little low, well, do you have 6 months reserves? There you go. That might just be what we need to get us over the finish line. Credit, what counts? Slow pays, so any kind of, late payments. Bankruptcy, it's a big hit. Foreclosures, huge. Collections, charge-offs. Collections generally more. Charge-offs, they're not as harsh, but they can affect your score. I'm going to, let's see if I can do it here. Drop something in the chat real quick. Let's see. I might do it at the end because I can't figure it out right now. But I have a little list of what the timelines are for collections, foreclosures, bankruptcies for each loan program. So, well, I just had a foreclosure. How long do I need to wait? Are we looking at an FHA loan? Okay, refer to the chart. I think it's 7 years. Ugh, that's a rough one. What about my Chapter 13 bankruptcy? Well, if no foreclosure was eaten up in that and you've been on time with the court on your payments, only a year. We only need a year. We just need the court to sign off that you can go ahead and buy a new home. We just did one of those. And I think it was even less than a year. We got it through because the court approved it. I think it had been 9 months maybe since the discharge. So, definitely have some options there. And if you have any questions, always a phone call. All right, let's see here. So we have a pre-qualification, we have a pre-approval. Time to go find a home. This is where you all come in. I take a back seat and I'm just there for any questions. I'm happy to run a monthly payment, look up taxes, all of that. Once we find that home, we're going to make a formal loan application. I'm going to plug in that address and 10 different red flags pop up in my system that say, all right, it's time to meet all the federal compliance. I need to send a bunch of documents to these buyers so that they have all the disclosures, they have their loan estimate, they have the formal application. That all gets sent out to them within 3 days of plugging in that address. Once they sign everything, it comes back to us and they have signed an intent to proceed. That's basically saying, all right, cross country, we're good to go. You can move forward with this. The only thing that they're going to pay for upfront in the process is the appraisal. We'll collect that at that point. After that, any kind of documents or questions I need just to kind of finish up the file, and then it gets sent off to processing. Processing will order the appraisal, prepare the loan to go to underwriting. We will be looking to get the buyer's homeowner's insurance put together at this time. Most homeowners insurance companies, pretty quick, some slower than others. So, usually we say, go ahead and start getting this going so that we can get it rolling on our end. Everything's put together, it goes to underwriting. Underwriter's going to take their review of it, and more likely than not, they are going to have some questions for us. They're going to have some conditions, and they're going to issue us a conditional approval. They're going to say, give me a letter of explanation on this address that popped up on their credit report that they didn't put on the application, or it looks like we're missing the most recent pay stub. Go ahead and grab that. At that point, I will send out a conditional approval to the buyer saying, hey, we're approved. I just need, these set of items. Also, we're working on this set of items on our end that you do not need to worry about. Most of the time, appraisal, homeowners insurance, verifications of employment. Once the underwriter approves it, and we have all the items put back together, we update the file with everything they asked for, send it back to them. Assuming we have the appraisal back too and everything looks good, we throw that in the file and we say, all right, underwriter, here's everything you need. Takes them a couple of days usually, sometimes, less than 24 hours, honestly, we're pretty quick. We will get the formal approval, the clear to close, basically. Once I have that clear to close, I'm going to let everybody know, send out a bunch of emails saying, hey, good news, we are clear to close on this loan. I'm going to reach out to the title company and say, all right, title, go ahead and schedule this buyer, and we will start working on closing documents. It'll go into our closing department where they'll prepare final disclosures, that final closing disclosure. The buyer's going to get sent that. They're going to sign it. That's important for compliance because once they sign that, we cannot close for 3 days. I'm sure you've heard that one before, especially, whenever you're taking your tests in the beginning. That 3-day right of rescission, we're stuck. So that's something I keep an eye on very closely to make sure that we make our closing date and that closing disclosure is signed on time. Once it's signed off, scheduled, everything's good to go, we just wait and then we close. If there's any questions you have along the way, this is probably the happiest, most quiet, part of the process as everyone just waits to, sit down with the notary and sign off on everything. Application checklist. So this is most of the time what I'm going to send people. What do I need? What kind of documents do you need? Well, I can rattle it off pretty quickly. We're going to need 2 years of W-2s, 2 years tax returns. This is more of a caveat. This is going to be for self-employed borrowers. We don't need tax returns on every single person. We're not ordering tax transcripts for every single person. 30 days of pay stubs. If you're paid every 2 weeks and that's only 28 days, that's fine. But if you're paid once a month, we'll need that pay stub. Once a week, we'll need 4, that kind of thing. 2 months of bank statements. Official bank statements, and the one thing that I chase down more than anything is all pages, even if the pages are blank. It seems like a silly rule, but the underwriter really must have all pages. And the easiest thing to do, one thing that I love that we have is we have a portal called Blend. It's the same portal that buyers will use to fill out their application up front. Most major banks, even small banks, regional banks, are linked to that portal. You can link your bank account, username, sign in through their site. It'll link it to our Blend portal, pull in everything we need, and the underwriters will accept that immediately. That's we're encouraged to use that. So I let buyers know, hey, if you don't want to mess around on their website or have to go to the teller and ask for a printed out sheet, and you're comfortable just logging in online, I'll send you a request. It could be done within the next couple of minutes. So rent receipts, landlord information. So we have to do this sometimes on FHA, not all the time. We may be required to get a verification of rent just to verify that they were on time for the last 12 months. Easiest way to do that is to just get the landlord's information and give them a call. Or if you want, we can collect bank statements for 12 months showing that you paid your rent every month on time. Divorce decree and separation agreement. Those are required just to make, kind of see how the assets were divvied up. If there's a house involved, we need to see that, your buyer's no longer required to make that payment. Maybe, if there's any kind of child support agreement, if our borrower's the recipient of that, we'll need it to verify that they are going to receive that for the foreseeable future. If our borrower is paying the child support, we just need to see the numbers on there, that the agreement, how long it's going to last, things like that. Oh, there it is, child support. Credit explanation letter. That's usually just, hey, you've got a collection on there, can you just put together a brief explanation of what happened? Why'd you miss that? Or you got a few late payments on there. What happened there? Most of the time, assuming, it's a, pretty likely story, the underwriter just says, okay, thanks, that kind of fills in that gap. They're more or less just looking to understand, well, I got in a car accident and went to the hospital and I missed my payments and it didn't dawn on me till later. So I went back and, I caught up. Okay, fine. We'll put that together in a letter and we'll send it in. And most of the time it's no big deal. Application fee. Once again, no fee to apply for the loan. Purchase agreement. We'll need that, obviously. Most of the time that's coming from you or your office admins that are going to allow us to make that a live deal. So just some miscellaneous items here at the end. PMI, I think I covered most of this already. A few loan programs that we have that, are non-conventional, non-conforming, specific to cross-country. We have a signature jumbo loan. So anything over the conforming loan amount, which I believe is 640. So if you've got buyers out there looking for $1 million loan, we have a program that can help them. Doctor loans, super, super awesome program. I love it. If they are a physician, if they are a dental resident, anyone that's basically getting their doctorate in the medical field is going to qualify for this loan. No money down, up to a $750,000 loan amount, no PMI. And then if they want to put a down payment down, we can go up to $2 million on this program. Super, super awesome. Do a ton of them for residents that have just moved here. So woohoo, you match with the Cleveland Clinic. Now you're moving to Cleveland and you got to live within 20 minutes. You're probably looking at Shaker Heights, University Heights, Cleveland Heights. And, first time home buyer just got out of school. This doctor loan is so awesome for that. And most of the time, they're very upfront. They're like, look, I'm living here for the next, 5 years and then I'm moving on, maybe move up. Maybe we move from University Heights over to Shaker Heights into that bigger, more expensive house. Cool. This doctor loan is perfect for that. Renovation loan. Don't do a ton of these because contractors are hard to come by and a little expensive at the time, especially with lumber being so expensive. But we do have a program where if you find a property and you think it needs a little work, we can, we have a whole team at Cross Country. All they do is the renovation loan. We'll go ahead and pass you off to them once you're pre-qualified pre-approved. And then they will kind of walk you through that, finding a contractor, coming up with all the repairs and renovations that you want to do. You close up front, so you own the property while it's being repaired and renovated, and the final product just has to be inspected and make sure that everything turned out the way it was originally intended. New construction, similar. We have a department that all they do is new construction, and this is if someone has a piece of land, they want to pay a builder to build the house, but they want financing to do that. We have a department that's all they do. We will work with the builder so that they can request draws from us for each portion, like each phase of the building process, and we will fund that construction. So I think that's it. Any questions?
Chris, thank you so much.
Cool.
So if they want to get a hold of you, they just find you in the office, or you can put your contact info in the chat.
Yeah, definitely. I can do that right now.
Perfect.
So
any other questions, you guys? Sorry, I didn't mean to interrupt you.
Oh, no. I am in the office at least 4 days a week. I am having some car repair right now, or I would be in there myself. But I will be back in there tomorrow and likely for the rest of the week. And I'm always a phone call away. If you ever need a rush pre-approval, you have a question about financing. And the way that I like to do it, and this is the Sean Hadley brand, I would say, even if we're not the loan officers, even if we're not the lender for your buyers, or if you're the listing agent and you're getting, you have a question about a buyer's agent, they're telling you one thing and you're not sure, give us a call. We're in the office to help you, even if you're not using us. So if you have a question, you know, my buyer's working with this other lender and they're telling me this, is that real? Is that right? Stop by, knock on my door, shoot me a text, whatever. Always, always, always glad to help.
Awesome. And I just put your phone number and your email in the chat, so everybody has that. If there are no other questions, then just thanks so much, Chris, and come back anytime. And I know you have some really great classes coming up in the Market Center as well. So looking forward to that.
Awesome. I appreciate it. Thanks, Katie.
All right. Thanks, everybody.